The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
So as we look at the market, and what you just commented on with regard to the international stuff, is international is usually in a dedicated allocation in most people's portfolios. The financial industry basically says diversify across all pieces of the market, and some of them will always work for you. And yes, there will be something that's always working, but there's also always something that isn't working. And in a standard diversified portfolio, you hang on to it. And what Perry just pointed out is that's not the way we operate. Our portfolios discard underperforming sectors and industries. One of the ways that we look at markets on a regular basis is to compare A and B. And so we're always changing A and B because different parts of the market here. This is basically a chart of inflation, deflation using a couple of bond funds, the inflation protected treasuries, and then the shorter term treasuries. So the first two quarters, the first two quarters of the year basically reflect the bulk of inflationary pressures. And what we see here is we've had inflation rising. Let me just explain this, how to read these charts, because I have a couple of them, I think. When the line is rising up to the right, that means that the indicator, the indicator that is in front of the two tickers is the one that is winning. When the line is dropping, that means that the second ticker is winning. It's dominant. It is outperforming the other. And this basically says that since late December, Treasury inflation protected securities are rising. There is a bit of a floor in here that looks like it. Investors are kind of still a little bit uncertain, but I drew a trend line in here because there is this tendency to have some doubt about whether or not we're actually going to see the Fed reduce interest rates because they see inflation falling, getting back to their 2% target. 2% over a long period of time is still devastating, but be that as it may, that's the kind of the acceptable range that government is willing to live with. Right now, inflation protected investors are saying they're not too certain about that. And they are beginning to demand or trade prices at such a level that they want a higher rate of return until there's more certainty about reduced inflation. And recent data suggests that that is problematic. The dollar and interest rates have both been headwinds for stocks, and it requires a little more scrutiny. One of the drivers of inflation, of course, was the massive amounts of money that were pumped in during the COVID shutdown. Not only did we have government handing out money, but the Fed was also printing money. And yes, the Fed does print money. It makes it up out of thin air. It was a bit of a shock to some financial media during an interview with Mr. Powell. And the statement was, you don't really make money out of thin air. And he said, well, yes, we do. That's exactly how we operate. They just create money and they lend it to the banks. Banks then fund our checking account and our loans. But the assets held by the Fed, that's basically creating money, which has fueled inflation. They've been trying to unwind them, and they're making some progress. But banks still need liquidity, and so they're using a, a bank repurchase window, which has kept the banks from going into default. And that's maintained some liquidity in our system, which has avoided a massive shutdown or collapse of stock prices. If liquidity dries up, prices will drop fairly rapidly and severely. So we have the Fed's balance sheet is kind of rolling over, and they're still managing to maintain enough liquidity to avoid major banking problems. The major burden right now on consumer inflation is shelter cost. And that's something that the Fed has been highly concerned about. It is a slow moving data. And the data that came out Friday basically said that the slowing prices in housing and rents have reversed to the upside. We had shelter rising by 0.6% in January, and that's stronger than normal at this time of year. The result is that we have a 6.2 increase for all of last year. That's more than double the normal average for this factor. And the housing factor is about a third of what the Fed is looking for in the inflation data. And until Friday's data came out, we expected that there would be lower mortgage interest rates, which would make it easier for new time buyers and an incentive for existing homeowners with a mortgage to sell, because they could go to another property and the mortgage rate shock would be less. But we're still facing a problem of people who own homes with a mortgage that they refied in the last couple of years. And so let's just assume they have a mortgage interest rate that's less than 4. Moving today to take on a mortgage that is above 7, and it even was as high as 9 not too long ago. And nobody's going to move and make that change. You'd have to downsize your house. This is a real problem for the Fed in terms of achieving the 2% target rate. What is selling and prices have been easing is new construction. But new construction has managed to be profitable for builders because they have reduced the size of the lots, the footprint of the house, and they've reduced amenities, and in some cases have helped pay down the mortgage rate. So the real question here with inflation is whether or not the Fed is going to be able to achieve its target as long as house prices continue to stay up. And here's the chart where we look at the repo facility, which is continuing to support prices. It is slowing, it is dropping, but it's still fuel for the economy, which is going to make the inflation fight longer than most people expected. I mean, if you've been following the markets at all, the discussion over the last year is how many interest rate cuts will there be? We came into the year, or we ended last year, with a major bet that there would be 6, in some cases 7 interest rate cuts throughout 24. The Fed has said that you don't count on that. And most recently have said, well, 3, maybe. And the maybe now looks like 2. And frankly, we would not be surprised if we don't see any rate cuts this year. if inflation persists at a higher for longer level, the Fed can't cut rates, and that is a major downside risk for the market. Now, the pressure on prices is easing more because more homes do come to market, and we did have a little bit of an increase in existing homes coming to market, but with interest rates on mortgages ticking back up, we don't expect that is going to last very long. This is the seasonality of the data that comes through as far as shelter is concerned, and it looks pretty much like the inflation data that I just showed you. This was the red is in the current data, the green is last year, and this is a 20-year average that runs through here. So from people who own a home already, and it's been a real boon because housing prices have continued to accelerate. It's added substantially to net worth. And for people who were on the verge of retirement, it was an extra addition to the retirement funding and security. I do not see any real strong justification to expect a collapse in prices like we had back in the 07, 8, and 9 meltdown. That was really a function of poor mortgage management as far as the government's intervention was concerned. And what it's happened is it's reflected in the home builders. Now, we own home builders in all of our portfolios, either directly or indirectly through some of the index funds where we don't have access to sectors. But home builders went through kind of this consolidation period early part of the year, trying to figure out whether or not this sector was actually going to continue doing well because profits were being pressured. And that was kind of the leftover from the COVID problems that were imposed upon everybody, but particularly home builders. But as mortgage rates have kind of stabilized, and as the factors that I just mentioned, they've got rid of excess inventory, land that hasn't been developed yet. They reduced the size of lots. They reduced the square footage of houses. They reduced the amenities that were attracting buyers. And that's kept prices for new purchasers in a range that was more acceptable. They've been able to turn over properties, they've been able to build out, sell, maintain profitability, and that has continued to push prices higher. First quarter earnings for home builders have been very positive, with upbeat forecasts coming from firms such as Toll Brothers, LGI, and TriPoint. The healthcare sector is an area that's normally very defensive when anytime anything slows down. And this shows that the first quarter in healthcare is unpredictable. I mean, it's very volatile. And then as we move through the year, the trends get stronger. The prices of hospital and related services have been ramping up. And we've seen that with other charts, that even though historically there's some selling here, that the current year's market is often doing better. With regard to healthcare, there's an inelastic demand for medical procedures and the ability of healthcare institutions to pass increased costs on to the end user. If the economy falls into recession, these groups are unlikely to see degradation in their pricing power, which happens with more discretionary groups. And it's basically a fundamental nod to this sector for risk management as well as returns through the year. Here we can take a look and see what has happened with the healthcare sector. And we can see that it has a great deal of volatility in it until recently. And all of a sudden we're getting, this almost looks like a technology stock running up through this, off this last October bottom. In one of our portfolios, we've basically rotated out of this particular fund into one which we own across the board into biotech. Now, biotech is on an individual stock basis is extremely risky because most biotechs aren't making money. They're all trying to find the next new drug, one of which recently is the weight loss drugs have taken off. And the company that did the original research on that has done quite well. Of course, they get bought out along the way. But we've rotated this because we think there's a lot more upside here from the current momentum and the indicators we look at. When we compare it to being invested in the S&P 500, which is the SPY or the SPY exchange traded fund, we had owned it previously and then sold it not too long ago because this rollover and the volatility of biotech posed some substantial risk. And when it fell below the 20th percentile in our pre-screened list, so there's a lot of other things that are stronger and that we should own those instead of finding out how bad biotech might get. Well, it did get bad and then it reversed and it's back rising again. And so it's been added back into the portfolio while we own something else that was doing better during this period of time. There's no way to know when this is going to fall and bottom out and come back up. That's a buy and hold mentality. This could just as well have continued to drop and drop and drop and get back into the October low of last year. When we look at the broader market, we find the same kind of volatility in the early part of a year. Some of this comes out because people are taking money out of assets to pay taxes. The tax bills do right here, particularly for smaller businesses. They have built up resources during the year. Some of those have been in the market, or they're in money market funds, which wouldn't show on this chart, but we see that cash flow changing. And once we get past the tax season, then there's a much more strength in the market. Way we participate in this is with something like the Schwab Broad Market Index Fund. Very inexpensive fund. The internal expense ratio is 0.03% per year. It went through this long valley as we went through 22 and the market was down, attempted recoveries, and they just never survived. We finally got some, and then it collapsed again back into last October and has been rising. So we had some resistance through here. We had some at the end of the year. This is where the uncertainty over what is the Fed going to be successful here or not? And now there's more certainty about we can live with interest rates where they are. Business is going to have access to borrow money, which is essential for small and mid-sized businesses. This particular fund covers about 2,000 stocks of all sizes and categories. So it's a good index. They obviously do some screening because they don't own 5,000 issues. And here's where we consider the comparison of the broad market to the S&P, to the Russell 3000. And as I pointed out earlier, when your trend line is rising, that favors the first ticker, which means being a little more restrictive with 2,000 stock exposure, still a broad index, is more favorable than owning the 3,000 complete Russell 3000 index. It just simply is a function of where's the magnet for money determined by investors. Investors go where money is well treated, which is one of the reasons the US market dominates global markets, is because we do have rule of law. We do have a Securities Exchange Commission, which for the most part is fairly rigorous. I mean, occasionally they get criticized for some of their actions, but it's a much more reliable market for integrity than any place else in the world. But as we look at the Schwab B on a more technical basis here, what we see is the 50-day moving average continues to move up. We have an upward trend line. This green line and the blue line, this is from January 1, this is from February 1, is basically tracking the volume that's going into this particular security. And as long as the volume continues to show up on a positive basis, then the majority of investors in the U.S. market who are looking for broad index exposure are attracting, are committing their money into these securities, and it's continuing to cause its elevation. This other chart is a 30-minute chart, and it basically tells us where's a short-term support here and where's a more intermediate level of support that would possibly cause us to rotate out of the broad market and look at a different index. These are not absolute. We have to take a look at what actually happens in the market and how investors are behaving. And that investor behavior is something like the old show, Who Wants to Be a Millionaire? And if you needed help on a question, the most reliable source was to ask the audience. And that's basically what these charts are doing. We're asking the investor audience, what do you believe in? And it shows up on the charts on whether they are optimistic or pessimistic. Now, those kinds of decisions force us to change our models. And if you were with us last month, this is where our models were invested at that time. These are condition adaptive models. So as conditions change, the models adapt. Each of them have a separate list or universe that the portfolio can be built out of. And so here's our current level of rotation. Perry mentioned that we don't typically look at international markets, but if you can read this, there's emerging markets right there, and over here is Japan. So when there is strength that is greater than other choices that we have, we pick them up. If they don't persist, they're going to come out of the portfolio. We are not in the prediction business. We're in the interpretation business. Look at what investors are doing in the market, segregate that information, refine it, and make a decision about where leadership is and whether or not it's persisting. This is not rocket science, but markets are dynamic. They're constantly changing, and it's not for slackers. The software that we use and what I just showed you is something that is for a retail investor is really very inexpensive, and it's something you can do on your own. It takes a while to understand what you're doing, but you set up rules and a process, and then you have to pay attention and make decisions. The tough decision is when your gut says this makes no sense, but the chart says it's the right thing to do. You have to be committed to make that decision. Someone needs to worry, watch, and finally make a decision. You can do this yourself. A little bit of training, commitment, dedication, and time. You can hire us. That's our business. You want to contact us, send us questions, help@IRI Radio. It's time for Q&A. I don't know, Perry, if you've watched for the Q&A, see what we have up on board. You want a free analysis? You're not one of our clients already. And we'll take a look at your portfolio. We don't need to know how much you own. We just need to know what you own. And we can do an analysis and tell you whether we think you're in areas of strength or not. Have a discussion about whether or not you need any help that we can provide. Perry, you can open your microphone.
We do have some questions on the board here. Let's just jump right into those. Tom wants to know, Tom says he's been hearing more about The BRIC nations, that's Brazil, Russia, India, and China. That's the core group. That's actually expanded a little bit, but anyway, those are the core groups of those international countries that have economic ties. They're doing more international transactions in Chinese currency. Is there a possibility that the dollar will lose reserve currency status?
My answer is no. I think that's highly improbable. The
I
dollar
would
does
agree.
go. The dollar does go through cycles of up and down, whether it's strong or weak. But the problem that the BRICS have is nobody knows what your counterparty currency is really worth. The dollar's had some weakness here lately, but since the first of the year, it's been up. And if we took a longer term picture, we would find that the dollar is generally strong. So Brazil and China did do, I believe they traded some oil.
That's it. Yeah.
They traded some oil, and it was reported that they didn't use dollars. Well, yes, that's true. But the question was, well, how do I know what your yuan is worth in my real? Well, the easy thing to do, and which is actually what happens, and it's the same thing that goes on between the Saudis and China, is, well, in Brazil, my real is worth so many dollars today, and your yuan is worth so many dollars today. So based on the worth of dollars, we can figure out how many of our own currencies we can swap and get a fair deal. We can do that because we trust the value of the dollar for pricing our currencies. Now, I mentioned a moment ago that one of the reasons the US market is the dominant market in the world is because we have the rule of law. And I happen to have had this discussion with an individual just a few days ago who's really convinced that the BRICS are going to replace the US dollar dominance. I said, well, first of all, tell me which country you trust. Well, I trust the US. Yeah, you don't trust anybody else. All these other countries that are putting together the BRICS are generally run by tyrants, socialist quasi kind of democracies that go through massive political turmoil. Brazil has a new election and the substantial financial problems, and the president just cut government bureaucracy by 50%. I mean, just fired everybody, basically. Got to cut expenses. Well, you don't know if that's going to survive or not. What if the military throws another coup and you've trusted all your money to be done in Brazilian real? That's not going to work. You trust the communists in Russia, you don't like them, so you're going to trust Putin? Which one of these guys are you going to trust? The only country in the world that has a legal system that is globally recognized as secure, a little fiscally irresponsible, but that problem persists whoever happens to be the reserve currency. The reserve currency will always have a need to create more money than their own budgets because they are stabilizing the rest of the world. So I don't think the BRICS are going to replace everybody. If you count all the little countries that have said, yeah, we'll join, I would argue that that's China going to these countries and saying, you want to do business with us? We want you in the BRICS, because China wants to be the reserve currency. But how do you do that when you're not a stable legal entity, a country that's recognized as stable and desirable by the rest of the world?
That really is their biggest problem. Yeah.
I would argue they're blackmailing countries into joining the BRICS, which is not
going to happen. And the country, whoever has the reserve currency, you have to be willing to insure the greatest extent possible that global commerce can continue. So you have to have the power to be a global policeman, to keep trade routes open, to keep countries free from trying to shut other countries out. And no one else can do that but us right now, the United States. Not saying that we're going to be doing it forever. We haven't been the reserve currency forever. It was the British pound, and right now it's the dollar, but it's going to be the dollar. And it's not just an economic decision that people are going to get together and vote. It really does, like you just said, Don, who do you trust? Who do you trust? And right now, even the countries transacting international business in their own currencies, they're still basing the value on the dollar. So it's still just a quasi-dollar trade anyway. So the reserve currency really is not at question right now, but boy, it is a popular topic to kick around.
The other issue with regard to the reserve currency is, if you look back over history, it changes at the end of major war, because whoever
Sure.
had been the reserve currency used up all their money or lost the war. And we became the reserve currency, replacing Britain after World War II, because they were bankrupt, they were broke. And we were the only country that had money to lend anybody for rebuilding. So it was the US dollar that rebuilt Europe and rebuilt Asia. But we don't know, if we get another major war and we lose, then we're not going to be reserve currency. I would not be investing on that basis.
Right. Okay, Rick would like to know, should traditional IRAs be converted to Roth IRAs if you're in the 12% tax bracket to avoid RMDs? We actually get that question quite a bit. Should you transition from a traditional to a Roth IRA? And basically the biggest driver is, can you pay taxes on that traditional IRA when you can convert it to a Roth with funds outside of the IRA? If you're having to liquidate the IRA, the traditional IRA to pay the taxes, which is what happens when you convert from traditional to the Roth, because you get rid of the RMDs, you get rid of all taxes on the way out, you pay them on the way in, and the amount that your IRA is reduced is substantial by the amount of tax you have to pay, and it takes years to recover that. So you're really handicapping the amount that you can grow once you make that transition. If you can pay the taxes with outside funds, then there's no reason not to go ahead and do it. There is still a risk that in the future, that Roth IRA, which is not taxed on distribution, could be taxed on distribution, because they can change the law, which is just what they did with Social Security. It used to be you would get Social Security tax-free, and then it was like, well, wait a minute, let's add some tax to that. And there's nothing that says they can't do that to Roths also. We've seen none of that. There's nothing saying that's going to occur. It's just possible. So it's something else to think about. But mostly it's that tax question. Can you pay the taxes with funds outside that traditional IRA and not just deplete your traditional IRA by paying the taxes to get to that Roth? If you're opening one, open the Roth, not traditional. But if you're converting, it gets a little more complicated. It needs a real close look taken on a case-by-case basis. But usually that's one of the prime drivers. Can you pay the taxes outside of the traditional IRA? You got anything else for that, Don? Or is that's
no,
that's
it.
Yeah.
It's a function of what you lose capital if you have to pay the tax from inside the IRA, and you've already have it in there, and your capital cost of capital is just too expensive to try to replace that. So I agree 100%. If you have outside cash to pay the new tax, then it's worth considering. Some of that's a function of your age and whether or not you're going to need to tap into the money at all. But if it's something that you can leave for an extended period of time, typically no less than 5 years and preferably 10 before you have to touch it, then there's an argument for the rate of return to be in your favor for doing that.
Okay, Mark would like to know, is the hype surrounding green energy and electric cars starting to calm down? That's a good question.
Well,
Because there's a lot of it. There's a lot of hype on green
uh,
energy and especially electric cars. Holy smokes.
yeah, on electric cars, Apple has been trying for 10 years to enter the car business, and they announced this last week that they are abandoning the billions of dollars that they have spent, and that entire project is being shelved. Uh,
Yep.
China is winning the war on who's going to dominate the business. If you follow the Tesla et al., they've been cutting prices both overseas first and then here in the United States because the BYD, that stands for something in China, I don't remember.
There you go. Yep.
But BYD is the number one provider, seller, manufacturer of electric vehicles in China. They have overtaken Tesla. They are bringing their product to the United States. And if I recall correctly, they have a car available, an electric vehicle, for about $11,000. Well, that's much cheaper than the cheapest Tesla. And it's way below anything that Ford and GM were even thinking about. So Ford and GM aren't totally shutting down their operation because they have too much government money. And the current administration wants to give them more to keep building something that is sitting on lots. There have the news of electric batteries, car batteries blowing up, starting fires. And once that fire starts, they're almost impossible to put out. And the cold weather has limited the functional use. I mean, I don't remember the city in the north that northern states in the Midwest bought electric school buses because of a big grant from the federal government. In the winter, they can't make their run because the cold weather and batteries don't go together.
That is a problem, yeah.
So those things are winding down, and the shift to green energy is facing the problem that the windmills that were put up 20 years ago are at the end of their life and they need to be replaced. And some of them are so remote that they're just going to be left there. There is money to be retrieved by recycling the copper, but most of what's in a windmill isn't copper. So the cost of tearing one down can't even be recaptured. So we were talking about this earlier in the week. I'm basically joking that if the aliens from outer space get here in the next 100 years and they look around and they find a whole bunch of these dead windmills out in the outback someplace, it's going to raise a question of what did they bury underneath there?
Why are they there? Yeah.
So we need more territory, but the economics of this are beginning to become very, very difficult to continue except for government intervention, spending money on something that the marketplace says doesn't work. I mean, you build a hydroelectric plant and it can last a century. You build a wind farm and it lasts 20 years. And then you've got to build a new one. And we don't know what to do with all the material that's left over that cannot be recycled.
And there's a lot of it. Yeah, there's a lot of it. And it really comes down to it at some point. It doesn't matter about your point of view. Everyone is pro-environment. Everyone wants a cleaner environment. It just comes down to dollars and cents. Does this make any sense at all to spend this kind of money on something that cannot produce the energy requirements that we have? And so it just that question begins to answer itself outside of government channels. And currently, that answer is we're not there yet. Hopefully we'll get there, but we're not there yet. And so, yes, all that hype is calming down, and the huge charge, which looked inevitable, is now looking much more questionable just because of the dollars and cents involved.
In the Nordic countries in Europe, they are actually disassembling their wind farms because they are not productive. And during cold weather, in the winters, they freeze up and they end up having to use helicopters to go out and de-ice the wind, the veins, in order for them to spin. And so that instead of burning natural gas to generate electricity, they're burning jet fuel to keep those helicopters in the air, which is, it's self-defeating. They spend
Not quite the point. Yeah.
Yeah.
That was a final question. The board's cleared on. We are clear.
Okay. Let me just make one comment on. I have a chart up here on NVIDIA that just briefly touch on what's driving the market right now. We see some stuff that's going on that, frankly, if we don't get lower interest rates later in the year, this recent spike in NVIDIA and the other AI related stocks is going to unwind. What this shows is accumulation by institutions, and there is some uptick here, but it's at a level that suggests this is being driven by investors coming back into the market and buying index funds. This isn't high enough to reflect accumulation by major institutions who are just coming back into the market. They owned NVIDIA back here and have systematically sold it last year. This is ETF accumulation. It's indirect. In this particular case, the company's revenue is growing rapidly, and that's adding investor excitement, but earnings growth is much slower. It's not keeping up. They need to innovate. Plus, they are going to spend a lot of money adapting their product to individual companies and countries. They are a leadership position, but the growth rate that we've seen here is speculation rather than fundamental valuation. That remains a risk in the market that we believe is quite real, and it would not take a major disruption in the assumptions about interest rates and what the Fed is actually going to be able to do for us to see a major correction, which would, in this case, over $800. This is the fundamental value back down here around $500. That would be almost a 50% drop to back down into a level that we think would be financially supportable from a company investment standpoint. Those are concerns we have. You want to know whether or not that affects your portfolio. If you're not one of our clients, we're already addressing that. But if you want to know whether or not your portfolio has those kinds of risk in it, we'd be glad to work with you. It doesn't cost anything for us to do a portfolio evaluation. All you have to do is contact us either by phone or email, register for, or go to YouTube and listen to our podcast. We post, generally we post at least 2 a week. Keep you up to date on topics that we're looking at that should have some impact on the market and decisions. But ultimately, our decisions come out of what are investors doing and how is that impacting the stock market? Where's leadership? Get rid of the stuff that's lost the magnetism to attract investor money. We thank you for being with us. You want to contact us, do so right here. Register for the next webinar on our website and subscribe to our YouTube channel if you haven't already done so. Have a great weekend. Thanks for time with us today.